Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have the CEO, Jeff Swainson, from Simply Solventless Concentrates. Simply Solventless trades on the TSX Venture Exchange under the symbol HASH, H-A-S-H. The company currently trades at 25 cents with about 50 million shares outstanding, or about a $12.5 million market cap. Today is April 30th, 2024, and I'd now like to hand it over to Paul Andriola.
Thanks a lot, Trevor. Yeah, great to have Jeff here. Sort of timely as well. We saw some news leak out of the US that there might be a change in the scheduling of marijuana. So a lot of stocks got a little bit excited today, but we're here to talk about Simply Solventless. Jeff, great to have you here. We did, Trevor and I did have the opportunity to go and visit the site about a month or so ago. So we've got a little bit more understanding of the business, but it's great to have you here so that we can get everybody else to understand the business a little bit better. So I'm going to hand it over to you. If you've got a presentation, I'll just let you go as you will.
Right, Paul. Thank you very much for having me. Obviously, it was great to have you out at the facility about a month ago. And in the presentation, I'll try to give a fairly high-level overview. Won't go into too much detail. Of course, we can open up for questions at the end, but we are really excited about the positioning of Simply Solventless and kind of the progress that we've made in the last year and a half. And so if we go into our mission, and that's really what it's all about, is our mission is to provide pure, potent, terpene-rich, ready-to-consume cannabis products to discerning cannabis consumers. And the ready-to-consume aspect is probably the key here. We do have, significant presence in the concentrates market, which is not generally ready to consume, but our focus is in infused pre-rolls and vapes across numerous brands. And this is essentially a summary slide of our business. And really what we've done and what we're about is organic branded revenue growth, opportunistic acquisitions, which, we conducted one already in the Lamplighter deal in January. Net income profitability, which is a rarity in cannabis, and a clean cap structure with no debt. If we start with the brands on the left here, so our initial brand was Astrolab. We launched that in May 2023, and then we launched Fruity Hootie in November of 2023. We built up to about 7 million annualized revenue for 2023 with those brands and our B2B and tolling business. And then we acquired Lamplighter in January 2024. You can see here our annual results. We released on Monday, 7 million gross revenue, 2.2 million adjusted EBITDA, and 1.9 million normalized net income. And so our net income percentage is really unprecedented in cannabis from what we see. But really, it is just the beginning. With the acquisition of Lamplighter, which, as I said, we closed in January 2024, we're essentially doubling our revenue. So we gave guidance of 3.1 million gross revenue in Q1, and net income of about 10%. And so 2024, really our mantra here in 2024 is the year of more. And so how are we going to expand the business? How are we going to create value for shareholders? And it's really in multiple different components. So number one, organic branded revenue growth. So with our existing brands, that's more listings, more product listings. So right now we have approximately 30 listings across the country. We're predominantly in Ontario and Alberta. So we have a lot of low-hanging fruit in expanding into other jurisdictions. So we just launched in Saskatchewan recently. We announced last week we're looking to get into Manitoba. And the biggest one that we're not currently in is BC. BC is about the size of Alberta in terms of the market. And so, in expanding our listings across the country and in entering into new jurisdictions, there's a lot of low-hanging fruit for revenue expansion. And with that revenue expansion, it's more market share. We're a very insignificant player in terms of market share right now at about 0.3%. By 2024 exit with 20 million revenue, anticipate will be about 0.7%, with the leaders till rate at about 12%, decibels at about 7.5%. So that gives you some context on the size of the business. Our business plan isn't so aggressive, as to be unrealistic. These are achievable goals and achievable targets that we're setting for ourselves. For 2024, we're looking to do approximately 20 million of gross revenue and to have normalized net income of approximately $2 million. And so into our brands, I gave an overview of the brands at a high level. And so Astrolab being our first brand, it's a solventless brand. So when we founded the company in July 10th, 2020, it was a solventless ethos. We recognized that the concentrates market was wholly unserved in Canada. And in the States, it was about 10% of the market. And so when we founded the company, it was less than 1% of the market here. It's now about 5%. And only a portion of that is solventless, though. Solventless essentially means that we manufacture without the use of any solvents or volatile chemicals. So our processes are mechanical separation of the trichome heads, either through dry sifting. So basically just screens, and that's how they would do it in historically hash making for thousands of years. They would use screens to agitate the cannabis and get the trichomes off. But we also do something called ice water extraction, where we take fresh frozen cannabis flower and we essentially put it in machines where it agitates it and uses the cold temperatures and the water to break the trichome heads off the cannabis. So cannabis connoisseurs love solventless products because they're pure. They're not ever in contact with volatile chemicals, and they're really a true expression of the plant. Whatever that plant's terpene profile was, whatever that plant's flavors and aromas and everything, it's just amplified by the ice water extraction process. And so it's a great set of products. We essentially commercialized at a scale that was unprecedented for solventless. We have a 30,000 square foot facility outside of Calgary, Alberta, and right now it's essentially just solventless manufacturing and fulfillment. So we do ice water extraction, we do dry sifting, we do vape filling, we do pre-rolling, we do packaging, labeling, excising. And really it's the packaging, labeling, excising that's the focus of our business, because it's fulfillment and distribution that we see as the main challenges in the industry. And so what we recognize, though, with Astrolab is that while the brand is popular and it's gaining great recognition, we're not going to have a successful business with one small concentrates brand. And so what we want to do is we want to bring solventless products to larger markets. And the largest markets in cannabis right now are infused pre-rolls, vapes, and it's predominantly flavored distillate. And so we launched a brand called Fruity Hootie, which is, we call it live rosin amplified distillate products. And so it's bringing the solventless full spectrum experience into more of a broader market appeal product. So we launched Fruity Hootie in November. We've had really great reception with it. And we continue to add new listings in Ontario. We're launching in June with 5 new listings. And we're looking to get into BC, as I mentioned. And then with Lamplighter, so you have Astrolab, which is pure solventless. It's the most connoisseur, highest end products you can have. Fruity Hooties, bringing that full spec experience to the masses. And Lamplighter is the pure high potency flavored distillate products. With Lamplighter, we had the number 13 1.5 gram live rosin infused pre-roll in Ontario for January, which is a big accomplishment for us. And we're rolling out new formats for Lamplighter into the concentrates category. And we're essentially getting the listings going again from when we transferred them over from Daicar Pharmaceuticals, is the company that we acquired the brand from. And so all 3 brands are gaining momentum. They're all headed in the right direction. They're growing organically, and we're really just kicking off our marketing efforts on these brands. And we expect solid growth organically going forward. We hired a gentleman named Jeff Lawrence in January, and and he's done a fantastic job of building relationships with some of the large retail chains. We're in one large retail chain right now, and we're looking to expand into another 2 within a couple months, and we're gaining a lot of traction there. And then this is Lamplighter, of course. We've transferred 12 out of 21 of the listings that it had when we acquired the brand. So, just over half. And we've already received purchase orders on a monthly basis that are analogous to the run rate pre-acquisition. So the acquisition is going very well. We acquired Lamplighter for only $600,000, which is the net asset value of the inventory and the intellectual property and the assets that we acquired. We value those assets at over $1 million. But we acquired the brand for $600,000 on a fully vendor financed basis. So essentially, we don't need to pay the cash for this brand until we've made the sales. So we feel it was a highly accretive acquisition. Obviously, from a revenue perspective, we didn't have to incur any dilution whatsoever, and we essentially doubled our revenue run rate. And here's just a list of the 1.5 gram infused pre-roll SKUs in Ontario, and you can see that General Admission dominates the market. Shred X is doing a fantastic job as well. But really, we were up there with the really big names in the space, and staying there and growing that business is a challenge. But it's very high potency products with Lamplighter. So the infused pre-rolls of Lamplighter are over 50% THC, and there's not a lot of players over 50% THC. And so more revenue. So product listings and market share. As I noted, Tilray's leading the market, 13% market share, Decibel's 7.5%, and we're 0.3. You can see in May 2023, we had no listings. We just, we had 10 by the end of May. And then we layered on some third-party brands in addition to our Astrolab, and then Fruity Hootie, and then Lamplighter. And so the revenue growth, there's a strong correlation clearly between listings and revenue. And so we're going to continue to be aggressive with our listing process and to gain access to markets with various different product formats and brands, with the intent of ramping our market share and our revenue. And then more net income. And so here's the rarity in the space. I think we all know that net income profitability is something that isn't common in the cannabis industry in Canada. There's multiple reasons for that. I think clearly excise is one of the main reasons. Our excise rate that we pay is about 45% of gross revenue, top line. And there was talk about the excise rate changing to 10%, which would have, of course, helped the industry, but they didn't change it. And so a lot of companies are really struggling with paying their excise balances and with achieving profitability with this excise regime. But in our Q1 guidance, we guided 310,000 net income on 3.1 million gross revenue, so 10%, which is it's among the highest profitability percentages in the industry that we can see, and we're trading at a 0.71 multiple right now. Generally speaking, companies that have above 1% net income profitability are trading at a substantially higher multiple than us. So we do feel that we do have ground to make in terms of our multiple. But more than that, we believe that we can really expand value through revenue growth. And so as noted before, we did 7 million in 2023. Our business plan is 20 million for 2024, which is substantial growth, of course. We think that there's a lot of upside in terms of our current multiple, that we're undervalued in relation to our peers. And with just achieving what we believe is a pure revenue multiple, there's significant upside in terms of our valuation, and then also increasing our revenues is going to help substantially as well. And here's our cap table on the left. As Paul or Trevor noted, we have about 53 million shares basic. We have a clean cap structure. All our dilutive instruments are about 20-cent exercise. We have in total about 26 million warrants that expire in 26 and 27, August 2027. And we have about 4.3 million employee stock options outstanding. And on average, their exercise is about 20 cents as well. So we believe that with continued execution and results and driving our business plan and keeping our promises with investors, which is important to us, that those will likely be in the money. And with that, we don't see the need to access capital in the market, barring some unforeseen, at this point, use of proceeds. We currently have about 3.6 million of working capital as well and no debt. So essentially, when we acquired the facility in June 2022, we had in total 9.2 million debt. That was comprised of a 6 million vendor take-back mortgage, a $2 million royalty payable to Sundial, and 1.2 million of convertible debentures. In August of 2023, we did a sale leaseback transaction. The sale leaseback wiped out all of the vendor take-back mortgage and the royalty, leaving only the debenture outstanding. Then we did an equity offering and converted all of our outstanding converts into equity, and that was completed. So we went public on December 18th with no debt at all. We felt that in the context of the cannabis space in particular, having any debt at all and going public wasn't a good recipe. So we wanted that clean cap structure, and we were able to achieve that. Here's a high level of our progress over time. I think ultimately what it comes down to for us and our value proposition is that we've demonstrated that we're able to achieve results. So first of all, we've been stewards of capital. We've raised about $5.8 million to date in cash, and our enterprise value is $9 million, about 12.5 million market cap right now. So we're one of the few cannabis companies that's worth more than we've raised. And that means something to us. And we take that very seriously. And so as stewards of capital, looking to generate returns on capital for our investors, that's positioned us with credibility. And we believe that with the excise regime, as I noted before, a lot of the companies were expecting a change to that. And had there been that change, there may have been a fury of consolidation and mergers and acquisition opportunity from the large LPs acquiring smaller ones to maintain market share. And of course, I'm speculating, but the excise didn't change. And so there's a lot of companies in very compromised situations right now that have large balances owing to the CRA and secured debt. The companies with the secured debt and those large CRA balances are facing a almost insurmountable challenge right now, and we do expect that we will see further CCAAs in the space. And with those unfortunate events, we're positioned to capitalize on that. We're positioned to be opportunistic. So not only can we drive revenue growth organically with our brands, there's an opportunity in front of us to capitalize on very, very good valuation assets and brands and revenue to layer on incremental revenue, incremental gross margin with our very, very reasonable fixed cost structure. So right now, our total costs per month are about $400,000 per month. We believe that we could add significant revenue on that with only 100 or 200,000 of additional fixed costs. And so we believe that sets us into a fairly unique position. And number two, with Lamplighter, there was a lot of different companies vying for that brand to acquire it. We won because we put a really good offer together, but ultimately because they believed in our team's ability to execute. And so the credibility that we're building over time in results and in deal making, transaction ability is putting us into a place where we're probably one of the companies that's going to be able to capitalize on this situation and to acquire assets for very good valuations. As you noted in this slide, most of the companies are trading at very low multiples. We're talking, Heritage is now in CCAA, but, a lot of the other companies, they're at a 0.4 or a 0.5, 0.6 times gross revenue multiple. In distressed asset situations, we believe that assets could be acquired for even less than that. And so with continued results, with getting our story out there and engaging with the investing public, and any appreciation that we're able to have in our valuation multiple into trading to peer multiples, we believe that we're going to be able to acquire assets for a 0.25 or a 0.3 or a 0.4 and convert them into strong revenue generating assets with our profitable structure and a much higher multiple. So that's one of the key strategies here for us, is to make these acquisitions, to bring on quality brands, layer on incremental revenue and profitability, and to convert that into higher multiples. And our team, obviously we've been very scrappy in our history. When we founded the company, essentially cannabis started to roll over immediately, and access to capital was very scarce. And we, as a corporation, we essentially lived paycheck to paycheck for 3 years. It was very, very challenging. And the reason that we were able to survive and then thrive is because our team, we have an incredibly dedicated team. As I mentioned before, Jeff Lawrence, he's our Vice President Sales. Jeff Hall is our CFO, seasoned CA. Randeep Gill, we recently promoted to VP Commercial, incredibly talented individual. Murray Brown, he's 40-year engineer with, oil and gas services, manufacturing, and cannabis experience. And so really our team is really strong, very dedicated, and we roll up our sleeves. And so we've run this as a lean company. We don't have huge salaries, and we don't have huge team. We do what needs to be done with what we have. And that's how we learned to survive over the last 3 years. And that's something that's very important to us. And so that's the high level of the company. I believe we have a very, very strong value proposition. I believe, as I said, we're uniquely positioned not only for organic revenue growth and to be opportunistic with acquisitions. And I think that 2024 is going to be a truly transformative year for Simply Solventless.
Fantastic, Jeff. Thank you so much. For those that are listening and interested, just a reminder, if you got some questions, please use the chat function, and I'll make sure Jeff gets a chance to answer your question. Jeff, let's step back a little bit, go back to the business model here, because you're not, when somebody thinks of cannabis in the space right now, they immediately think of grow up and growing flower and stuff like that. That's not what you do. You guys, if anything, you can take advantage of the circumstances in sort of the growing part of the market right now, but you guys are really focused on sort of the high end value added products that the consumer is really looking for. Is that correct?
Absolutely. And so essentially, in the infancy of legalization, there was a huge rush towards funded capacity. That was the metric that essentially the investing public crafted to compare cannabis companies against each other. So what happened was, whoever could build the biggest greenhouse with the funds that they had was rewarded for that. So people would just raise more money and build a bigger greenhouse, and then raise more money and build a second big greenhouse. Of course, that led to a huge oversupply situation. And so fundamentally, what we've capitalized on in part is that there's a huge oversupply of cannabis, and we process it. So we're taking a total commodity and processing it into consumer packaged goods. And so that's really the core of our business model, is cannabis processor. That being said, the commoditization of cannabis isn't limited to just flower. All sorts of cannabis derivatives are being commoditized. And so really we are in the consumer packaged goods business. we've been successful with our brands and creating the connection with the consumer because the quality of our product is so high. We've been able to take the solventless ethos and leverage really good supply chain relationships, and now not only connect with the solventless consumers and the connoisseurs, but to expand that ethos across different product categories and types, to where our high quality products are now available in flavored distillate and live rosin amplified distillate. And so we do have a competitive advantage there because we don't need to own huge amounts of infrastructure. We have as I noted, a 30,000 square foot facility, but our focus isn't on cultivation. It's on conversion. And so it's really about fulfillment. It's about distribution. And that is the challenge in the business.
Mm-hmm.
And so in this industry, you have obviously everyone fighting for a finite amount of shelf space. So how do you win? You win through product quality, and you win through keeping your promises. A lot of the current licensed producers that are on shelves and have significant retail relationships owe them a lot of money. And they've eroded the trust with those retailers, and in large part they've paid to be on those shelves, even though they're paying for data. It's called data deals because you can't buy shelf space. They've participated in data deals and they're on the shelves. And so the dynamic that was crafted as a result of that is that products that weren't of quality weren't the ones on shelves. You didn't have to have a good product to be on the shelf. You just had to pay to get it on the shelf. And so it's a very competitive market to get onto those shelves. And the products that aren't the quality products are being displaced by products that are quality products. And so that's our opportunity in terms of generating velocity, is our product quality is high and our products are in demand. And so back to the funded capacity crafted in early days legalization, that all the oversupply led to people making investment decisions based on scale. So instead of doing solventless extraction, they would do ethanol extraction. So they would make distillate, very high potency, but flavorless, almost odorless, tasteless. Those are the products that got on the shelves because of the problem that was created 5 years ago. We needed to process hundreds of thousands of tons of low quality cannabis. Thankfully, the market has evolved, and we've spent 3 years developing relationships and fine-tuning our processing capability on the solventless side to where it's highly economic and results in a higher product. So we didn't create this business to capitalize only on the oversupply. We did it to get on shelves, to connect with the consumers in ways that other LPs haven't.
Yeah. Jeff, one of the things that impressed us when we went and visited the site was, first off, you explained to us that there's inefficiencies or a number of different inefficiencies within the industry. And one of the things you explained was like to have a grow operation, for example, in the middle of Alberta, where energy prices are high, doesn't make a lot of sense compared to growers in BC, for example, where electricity costs are cheaper. So it was interesting because I really got to understand that there's different dynamics within different categories. Like you guys have a facility there where you're able to take advantage of, quite frankly, cheaper land than you would in say, Lower Mainland Vancouver, but also your labor costs are cheaper, and there's a number of other things that are cheaper that you guys are actually able to take advantage of while not having to shell out for the high cost of some of these other sort of functions. So that was interesting to see that. But the other thing that really impressed me is that your facility has tremendous amount of scale left. You're not at capacity. You got an opportunity to really grow with very little capex there. Whereas, we had seen another facility a couple of weeks before we saw yours where they were at capacity, and for them to really be able to grow, they're going to have to spend a lot of money to be able to do that. So it was interesting. Maybe touch on that. Like you guys really have I think you said anywhere from 5 to 10x revenue capacity from your existing facilities with not much in the way of sort of modernization or capital costs. Is that correct?
Absolutely. So first of all, in terms of power costs, you're completely right. I mean, we've had large scale shutdown of cultivation assets in Alberta, predominantly because the power costs are just too high. Uh, from if you drive up Highway 2 south going north, I mean, there's literally about 6 or 8 really good quality licensed producers that have entered into CCAA, and the power costs are just too high. Things like hybrid greenhouses and outdoor cultivation makes more sense, but we can't cultivate outdoors in Alberta. Our climate is too cold. So for here, processing makes sense because our labor costs are comparatively low. And then on to the second point of the question, in terms of scale, that's one of the things that excites us the most about where we are today, is that, as I was discussing earlier, we can add a lot of revenue for very, very modest increments of additional fixed costs. Our facility is 30,000 square feet. We're probably utilizing about 15 to 20,000 square feet of that. So we can add a lot of different product types. So we are solventless only in the facility right now, but we could layer on hydrocarbon extraction. We could layer on ethanol extraction. Hydrocarbon extraction would allow us to layer on more listings with the provinces and in different product categories that we don't currently have, such as live resin. The ethanol extraction would reduce our input on distillate by about 50%. We can do that all within our existing footprint without issue. And so the ability to layer on new listings, to layer on new processes for very modest amounts of capital. Like we're talking about hydrocarbon extraction, $500,000 to $1 million. We're talking ethanol extraction, $500,000. A lot of these can be leased. A lot of these can be acquired off the secondhand market for pennies on the dollar because of the situation that the industry is in. So the opportunity that we have in front of us with our existing footprint to ramp revenue is substantial, and to do so for very little incremental costs. And so, our VP operations, sorry, Paul, our VP operations says, oh, we can do 150 million out of this facility. And I feel embarrassed saying that, but he's probably right? With the right product mix, the right velocity of our SKUs in market, we probably could do 150 million. But certainly, with the right execution, we 50 or 100 million out of the facility is absolutely achievable.
Mm-hmm. Well, good. You just answered the question I was going to interrupt you with to ask. Just that, like, what could you do from that facility? So upwards of 150 million if everything is sort of goes in the right direction. Let's take a step back a little bit and just touch a little bit more on that Lamplighter deal, because I mean, it was really, you put up no cash for it. You got an opportunity to take over a brand. The deal basically pays for itself. But I want to sort of touch on that, and then really let's explore the opportunity. I mean, is there other deals like that out there, do you think, that you guys can pull off? What's the landscape currently look like for deals, or you guys have anything in the pipeline? Any of those questions?
Yeah, we're in discussions with numerous different groups. I do think that over the next few months, we will likely see some more distressed asset sales. We'll probably see some more entities enter into CCAA or receivership, and a lot of assets will be available. We don't have anything definitive at this point, or anything that we could announce, but certainly we're looking, and there's a lot of opportunity out there, and it's about being selective and not being impatient. It's about evaluating these opportunities on their own merit, and finding deals that work for us and provide the most value for our shareholders. As I said before, one of the kind of key mandates here is to take 0.25 multiple gross revenue assets and turn them into one. Right? That we feel that's low-hanging fruit, and those are the types of opportunities that we see out there. With our sales team and the connections that we're developing with key retail chains, and our ability to execute, it puts us in good stead to be able to take those low multiples and convert them into higher. And I mean, that's really, at the end of the day, notwithstanding integration is always a challenge on new assets. That's a huge opportunity for us to create value in a short period of time. And we wouldn't wish CCAA on anybody, but our capital stewardship and our ability to deploy capital and to create value with very limited capital, has resulted in these opportunities being presented to us. And so I think we have the team in place to close on these types of deals, and really, by the end of 2024, things could look much different for us in terms of our critical mass and our ability to generate revenue.
Mm-hmm. Now, Jeff, you were basically forced to play guerrilla warfare here in this industry. You weren't given a whole bunch of money like a lot of the other players have. You guys are obviously running lean because you were forced to, but now you've just been, you just raised $800,000. What happens with that capital? What's going to be the use of that proceeds right now?
So that's really velocity capital is the only way I can put it. Is we got into a situation where
hey guys,
brands.
Oh, we got. Maybe let's make sure everybody's muted here. But sorry, go ahead, Jeff. Velocity capital.
Yeah. And so ultimately, the large retail chains won't make orders of products unless you have enough in the provincial warehouses for them to satisfy all their stores with one order. So essentially what this capital is for, the use of proceeds, is to build our inventory levels, not just in our vault, but in the provincial warehouses, such that we can engage with the key retail chains across the country and have large drawdowns of our inventory. So really, I come from a world where working capital as use of proceeds is a 4-letter word. But in this case, really, it is velocity capital. We're taking that capital, we're creating inventory so that we can quickly monetize it and have higher inventory turn. And that's why you'll see in our 2023 results, our inventory increased. That's what our mandate is right now, is to with stewardship, increase our inventory to levels to where we can service multiple brands and do a nationwide rollout that's meaningful, that has scale that's meaningful and growth that's meaningful for our shareholders. And $800,000 isn't a huge financing, but what it can do to our business is substantial and it's material.
Okay, that's good to know for sure. What challenges are you facing now? You've come a long way in the last little while. I mentioned there's some challenges. You're happy that you sort of left in the dust here, but ongoing, what do you see the challenges for your business?
Well, it's always a competitive environment to get shelf space. It's difficult to generate velocity in your SKUs. And probably the biggest challenge for us has just been scaling, just the operational side of scaling. It comes with lots of different new challenges for us. We have a great team, highly experienced team, but the growth that we're experiencing is rapid. And, we're talking about in a year and a half going from 200,000 quarterly revenue to 3.1 million, and we're looking to grow significantly beyond 3.1 million per quarter. And so with that comes a lot of logistical challenges, a lot of supply chain challenges, a lot of timing challenges, and those are all solvable. Those are all challenges that our team is paid to solve, and that our team is adept at solving. And so really right now, aside from excise tax being punitive, 45% of gross revenue, just the challenges that come with scaling a business have been, one of the biggest things that we've had to overcome, and that we're doing a really good job of overcoming.
Mm-hmm. I really want to almost echo what you just said as far as the excise tax. Imagine any business that for every time you sell a product, 45% immediately goes somewhere else. That's what's happening here, right? So any change in the excise tax, that change goes directly to your bottom line. Like if there was even a 10% change in that, that's all that drops the bottom line. That's how significant any change in excise tax would be for you guys. It's pretty amazing. But I mean, you highlighted it in your presentation, but I really want to stress here the opportunities you guys have for sort of new initiatives. I always call it, whether it's new products or new territories. You guys are not in BC yet. You're not in Manitoba. You just launched in Saskatchewan, so you've really got some new territory that you're going to be able to grow into. But really, what sort of blew me away when I first saw it is that you guys are expecting to go from 50 products to 100 products at the same time going into different markets. Like how do you go from 50 to 100? How do you actually generate new ideas to the point where you're getting them done, made, and then getting shelf space for this sort of stuff? Maybe give us a few minutes there.
Yeah, and so with the listing, so one listing, so one product, so call it a wild watermelon coconut 3x0.5 pre-roll SKU. If it's in 3 jurisdictions, that's 3 listings, just to be clear on how that works.
Mm-hmm.
And so we're not adding 50 new products, but we're adding 50 new listings.
Okay.
And so how we're going to do that is, number one, product categories. So as it stands now, we're in infused pre-rolls, we're in vapes, we're in concentrates. And so there's opportunity to bring, for example, Lamplighter. When we acquired that brand, it was only pre-rolls and vapes, but to expand it into concentrates. There's opportunity, as I noted, for things like hydrocarbon extraction, where we can do it for very low capital investment. We can add something like 20 new SKUs in very quick order. There's things like we could expand into beverages, and I'm not saying we're going to, but there's opportunities in other product categories to layer additional SKUs where we don't play yet. We don't have edible SKUs. So with our business model and our ability to process at scale solventlessly, and the expertise that we have within our team, we're able to enter into new product categories, whether it be in Astrolab with solventless products, whether it be in Fruity Hootie, or whether it be in Lamplighter. And so having these brands, having the breadth of products, allows us to just increment. And of course, going into a province like BC, even if we launched with 5 or 10 initial products there, that's 10 new listings. So multiple ways to expand our listings, whether it be jurisdictional expansion. We have Manitoba coming, we have BC hopefully coming, then we have the Maritimes. Quebec is very challenging to get into, but we'll endeavor to do that. And then other product categories and types. So really, it seems daunting to go from 50 to 100, but we went from 0 to 50, having never done it before, in less than 1 year. We're not 1 year in. We launched 26 new products in February alone, February of 2024. So our ability to get listings and our ability to achieve those listings is there. And so that's a core competency of ours that we plan to continue to leverage to get up to 100 listings. But that's not the be all end all. We also need velocity. Sales velocity of existing SKUs is likely more important than layering on new SKUs. And so that's where our sales team is working very hard. We're developing a really good presence. We're attending more events now. We're just getting our social media kicked off. That's the bread and butter for this industry in terms of marketing, is social media, and we've been very quiet. We've done this on a complete shoestring budget on marketing. And so additional listings, we believe that we can achieve those, and that we can drive velocity of our current listings.
And I got to stress the real big takeaway that I had after visiting your site is that I would bet that for the size and market cap that you guys are, I don't think anybody has as much bang for your buck as far as scaling ability and capacity, right? I mean, you're arguably a $10-12 million market cap company right now, but you have the capacity to go upwards of $150 million without a lot of effort here. I don't think there's a lot of other companies that you can say the same thing about. So really impressed with that. let's talk a little bit about the stock. Now, you guys just went public a little while ago, but maybe talk to like insider percentage ownership and maybe a sense of what the other sort of the balance of the shareholder base looks like.
Absolutely. So we're about 30% insider held. Insiders have participated in every single financing throughout our history. We have serious skin in the game, and we're extremely committed to this business. We're not suitcase employees here for a salary. We don't earn huge salaries, and we're here for the upside and the equity. And we take that very seriously. Our co-founder, Bill McDonald, I mean, an incredibly committed individual and passionate about what we're doing, and our entire team is. And so, along with that, of course, with the high insider ownership and the recent go public means that we're largely escrowed. We have probably 19 million shares in escrow. I think that was originally, I think some might have come off. But we have upwards of 17.5 million shares escrowed right now. Not that we would trade them anyways, but the float is not huge. We have 53 million shares outstanding. Call it a third of that is escrowed, and very committed insider group.
Jeff, another thing I noted is that you're not you particularly, you're an accountant by background. You're a numbers guy, right? So you're not necessarily, you're not a finance guy that came from the capital markets. You're not a guy that was born in the legacy market here. You're a numbers guy. So when it comes to deals and profitability, it sounds like that's your forte. That's you're a numbers guy.
Yeah. My training is, as a chartered accountant, and it wasn't necessarily what interested me. I'm more into kind of strategy and just bringing people together to achieve a goal. But that chartered accountant training, it's pounded right into you, and it doesn't go away. And so, I tend to look at things from a numbers perspective and from a value perspective, and to try to build value, whether it's building our balance sheet, whether it's increasing our working capital. And there's numerous ways to do that. And in this business, there's no playbook. There's no predetermined best profile for an executive. And so we have in our team, we have a vast array of backgrounds. We have engineers, we have legacy market master hashishans, we have obviously chartered accountants, we have incredible sales people. And that's kind of one of the things that I think we have an advantage on, is that we didn't say, okay, we need CPG people. That's what we're just going to hire CPG people. Mm-hmm. No, we just hired dedicated, hardworking people with various backgrounds, and as a result, we have a lot of different insights and a lot of different perspectives on things. And I think that it's been successful so far in the mix of people that we have. And I think the primary reason we're here right now is because of our team, and I think the primary reason for our success moving forward is going to be our team.
Mm-hmm. So we do have a question that's come in, and I'm going to recycle back to some of the things that we were talking about earlier, and it's related to the assets that you're hoping to buy and how that could sort of fill out your capacity. Give us a better sense. Like if you buy an asset, let's say you're buying another brand somewhere, you're going to manufacture it and basically distribute it from your facility. Is that correct? You're not necessarily going to be buying a facility somewhere else that's got this. You're really trying to bring brands in-house so you can fill your capacity there. Is that correct?
Yeah. Predominantly, we would look to manufacture in-house. There are situations where we would use third-party co-manufacturing. But the number one goal is to fulfill our facility's capacity. To ship. Basically, it's all about shipments. How many shipments can we do to the provinces? And so if we're leveraging third-party co-manufacturing and then packaging, labeling, excising in-house, it's just all about having a consistent flow of products out the door. We do have a lot of room for different processing methods entirely, such as hydrocarbon and ethanol. And with the right acquisitions, we would look to layer that on, certainly, and to do it as much as we can in-house to leverage our team. But it would be a mix of both in-house manufacturing and third-party co-manufacturing.
Gotcha. So this question might be too soon, stage of your business right now, but let's look out a couple years. You're generating significant cash flow. You've probably made a couple acquisitions, but if you're starting to sit on sizable cash, where's the best utilization of that capital?
That's a really good question. I would say, ultimately, it's so hard to say where that capital goes, because how is the industry going to evolve? What's going to happen with excise? What's that going to do to our competition? Is there going to be a slew of CCAAs? Are those entities going to continue? So, to sit here and prophesize about what we would do, I mean, obviously things like international expansion are on the table. A lot of cannabis companies in Canada are already doing it. Companies with GMP certification. There's huge demand in the world for cannabis products. My inkling there, though, is that generally speaking, production will move towards the point of distribution. So assuming that they can do it on a cost-effective manner and their power costs are reasonable and things like that, I think that production eventually will go to the countries where the products are being sold. And so we don't necessarily see that as the strategies, international expansion. And so, in the case of sitting on substantial cash that we need to deploy, I mean, at that point, we're looking at share buybacks. We're looking at dividends, things like that. But there's a lot of work to do before that happens, Paul. That's we're early stage. There's still risks that we need to manage. There's hurdles to overcome, and there's a lot of revenue growth that we need to achieve before we're in a place where we have cash to deploy beyond, like, our deals that we do, our acquisitions that we look for. Those generally aren't even requiring a lot of cash. And so, we're going to just continue to be scrappy, and we're going to continue to do things, within our means, and we're going to try to create value with as little cash as possible.
So just a couple more questions, Jeff. One of the last ones is going to be just in general, like, as investors watching you from the outside, what do you think are the key metrics or catalysts that we should pay the most attention to or sort of watch out for?
So I believe, obviously revenue growth is very important, but profitable revenue growth. So I'm very much a believer in multiples and revenue multiples with profitability. I think net income profitability as a cannabis company is number one right now. A lot of people, adjusted net income, adjusted EBITDA, all the different metrics are important, and free cash flow is absolutely critical. But the ability to generate net income and to demonstrate basically full cycle profitability, things that are taking into account depreciation, all of the things that matter to demonstrate actual profitability, to build your balance sheet, right? That's what's the most important thing in my view. That's what gives a better valuation multiple in our industry right now. And debt. In this environment, debt is critical, especially secured debt. So parties that have secured debt and large CRA excise balances, those are the companies that are at greatest risk, in my view, of insolvency. And that's because the secured creditors just, they don't need to sit and watch the assets pay off the CRA debt. They can just take it into CCAA and then control the assets. So there's some companies out there that didn't have a choice, that had to take on debt on very unfavorable terms. We were fortunate that we were able to do the sale leaseback and extinguish our debt. But there's a lot of companies out there that weren't so fortunate. And so I think as an investor, I would be keeping an eye on secured debt and CRA excise.
And then just lastly, Jeff, anything that we missed, anything you want to cover, or any key message you want to make sure everybody walks away with today?
I would say just that we're tenacious. You know, we're a hardworking group of people. We're very passionate about what we're doing. We do believe that we've come a long way. We're proud of where we've come, but we have a lot of work to do, and we have a lot of value to create still going forward. You know, really, I hope that I have the opportunity to sit with you and Trevor and all of your subscribers at the end of the year and look back and to see how far we've come, because I do believe it will be very far.
Well, this has been great, Jeff. I certainly appreciate the time you've given us today. Really was impressed with the visit that we had out there your way. We've been speaking with Jeff Swainson, CEO of Simply Solventless Concentrates. Symbol is hash, HASH on the Venture Exchange. Jeff, congratulations on the accomplishments so far, and obviously we're looking forward and cheering you on. Hoping to catch up with you soon.
Really appreciate it, Paul. Thank you for the opportunity and your support so far, and it means everything to our team. So thank you.
You're welcome.